Okay. Okay. Good morning. Let's get started. So what we have discussed last week is just give everyone a, first of all, intuitive understanding about the risk and the return, and the relationship between the risk and the return, and how to measure the risk return in one perspective, just from one perspective. Basically, what we have discussed last week is totally measure the return is relatively no argument. Everybody agree we should measure the return in this way. But how to measure the risk? We have only discussed one possibility to measure the risk in last week, and we're going to switch to the first method to the second method, which is built on the modern finance theory, which is Kai-Pan, one of the important theories in modern finance theory. It's in CAPAN. How do we make this change or progression or advancement? It spanned about 20, 30 years for the academic world to really understand how we should measure the risk associated with different return. And that is marked by several important papers that eventually get awarded by Nobel Prize in this one dimension. So I'm very lucky and I'm honored to able to have this opportunity to share my own understanding of CAPAN, as well as the extension of the CAPAN and the foundation of the CAPAN. So basically what we have discussed in last week, it's about the foundation of CAPAN, how the CAPAN, the theory has been built up. You need some foundation. And the foundation that we have discussed so far is called a mean variance. It's Sharpe-Markowitz mean variance analysis. Your analysis and any investment based on the mean and variation. Why we should have the mean? Because the return in time series is not the same. So that's provide us an opportunity to measure what is the mean of the return. Once you measure the mean of the return, then you have another opportunity to measure for each individual return how much each individual return deviates from the mean. And then you measure the risk is measured by the total difference, which is measured by the square of each return from the mean and sum them up. That's how we call the variance. Okay? You should understand that the mean variance in this fashion, then that is going to greatly help us to understand why you should move forward. And what exactly is forward, that's what we're going to talk about. We're going to talk about from the theory of the capital market line, CML, to security market line. So even if the two graphs we're going to show you is relatively the same, but in terms of the understanding about the difference, it's evolutionary. It's evolutionary. And that's built on the CAPAN theory. And that's what we're going to talk about in today's work for first elements. First elements is theoretically, pure theoretical. So what does CAPAN tells us is, if you put it into the layman's English, is basically there is no free lunch. More risk, high return. That's what the CAPAN basically told us. The first information, what is the second information is, what CAPAN has told us, has showed us is, in theoretical foundation, all the return from different stocks in the markets should only be matter from one resources in terms of the risk. And what exactly is that source? It's the market risk. It's the same risk source. Now, how do we measure the different stocks have different variation or variance? It's because your different stock, each of the different stocks, they have a different exposure to the market risk. That's how we measure the data. So once we finish these two elements, then we have already built up one of the most important theory in financial economics in the history. That's called the CAPAN theory. But I'm going to keep moving forward on the third elements of the two lecture series. And the third element tells us, look, in the real world, CAPAN, the theory, is not consistent with empirical evidence. Or if we put it into the layman's English, is CAPAN did not work in the empirical evidence. And if CAPAN did not work, what works? That's another question. And I'm going to provide concluding this lecture by providing everyone with a possible solution. There's someone suggests something that works better than CAPAN, but only empirically. Okay? So that's basically what I'm going to do today in terms of the lecture. But let's start with some technical. Some people feel this is a little bit about mind twisting, or someone say, oh, this is boring, it's just punching a numbers. Let's, for whatever different feelings, let's go through this one first. Then after I finish this couple of questions, there are a few questions, I'll tell you why we want to keep doing in this way. Okay? Let's start with the first tutorial question here. Expected returns, this question is about. We have chosen biology as you have chosen biology as your college major because you would like to be a medical doctor. However, you find that the probability of being accepted into a medical school is about 10%. And if you are accepted into the medical school, then your starting salary after you graduate will be $300,000 per year. However, if you are not accepted, then you would choose to work in a zoo where you earn $40,000 per year without considering any additional education years or the time value of the money. What is your expected starting salary as well as the standard deviation of that starting salary? I like this textbook for a few reasons, and I mentioned the last time we have this perfume company that try to, the textbook designers are really mind-working, try to link the questions in the real world to what we have discussed in the academic classroom. And this is another one. But I have to point out that is, because right now everyone sitting in the classroom, there's a very low probability of the students sitting in this classroom thinking about going to the medical school. But look at the salary. This is not just make up the number. They are really making a lot of money. I don't know how much is making in Australia as a medical doctor, but I know how much is made in the United States. It's a really high salary. But the thing here is I think it's a similar situation in US as compared in Australia, is if you want to go to the medical school, you're going to prepare much longer years of education. And what's the second part? Each year you have to pay much, much higher tuition, much, much higher tuition. Medical school, we're talking about that it's 6 years to 8 years, but once you graduate, you get a doctorate degree, okay? And each year you have to pay very high tuition, especially in the United States. And that's why they could have much higher salary. Again, this is the question that we're going to learn. High pay and high harvest. You pay more, you harvest more. That's basically what we have done. Okay, so let's go back to this. Sorry. Okay, it's a bogey one. So this is, in addition to what we have discussed in real life, here is the expectation of the salary and the standard deviation of the salary. Once we understand the economic intuition, the calculation is pretty straightforward. 90% you're going to earn 40,000, and 10% you'll have the chance to earn 300,000, which is a huge amount of money. Then the average salary would be weighted average salary of the two. So that's what I highlight here. In terms of standard deviation is weighted average difference or distance of each salary to the mean. And we measure the distance of each salary to the mean by the distance minus mean to the square. That's how we measure this. And then once we measure the variance, we could easily calculate what's the standard deviation, which is square root of the variance, and that's 78,000. Everyone would think this is, wow, this is so simple, right? So straightforward. Why you should put it into a question like a tutorial? Let's keep moving on. This is from mean variation. Let's look at another one. Calculating the variance and standard deviation. Lin Yan is considering investing a share and is aware that the return of that investment is particularly sensitive to how the economy is performing. Her analysis suggests that 4 states of the economy can affect the return of the investment. Using the table below with information on returns and the probability, please find the expected return and the standard deviation of the return on LinkedIn's investment. So what we have the information here is 4 different states, and the 4 different states may or may not have the same probability for each state. And in this case, we have the good states, very good states. This is marked by boom, economic boom. I have 10% probability, economics good. We have 40% probability, economic is okay, or market as level. We have 30% probability, and if economic performance is poor, market as slump, we have 20% probability. And for specific stock, their return is, we use another word here, is asymptotic, or which means it's monotonic decreasing from the 25% when the economy is doing very well to minus 5% when the economy is doing very poor. So that's how we have here. And then we use the same methodology that we used in previous question. We calculate the expected return, and we calculated what is the variance of this return and standard deviation. So just repeat relatively the same calculation. One is the salary and education. The other one is stock return. And now you'll notice that the first 2 questions only refer to or ask you to do something about the risk and variance on single assets. Okay, it's a single asset. Now let's look at the portfolio with more than one asset. In order to understand this, yes, you can see that the designer of, it's not me to put these questions here. It's my predecessors to put the questions here, which I can really appreciate how they put the question in those sequence. Is on this question, they add another different assets, but they borrow the probability and the different states with 2 assets to let the students to appreciate the mean and the variance. Especially during this time, we like to know what is the covariance. Okay, so basically what we have done here is once you move into the world of 2 assets, and we pay more attention, let's put it this way. We pay attention not only to the variance of individual assets, but we also pay attention to the variance between 2 assets. That's how we describe the portfolio in the future. And then we have this one portfolio with more than one asset, given the returns and the probabilities for the 3 possible states listed above or below. Please calculate the covariance between the returns of the shell A and shell B. For convenience, assume that the expected return for shell A and shell B are 11.75 and 18% respectively. Okay, we have the return here. When economy of the stock A and stock B, when the economy is doing good, is doing okay, or is doing poor. 35 probability economy could be doing very well, 50% probability economy could be okay, and 15% probability that economy would be doing very poorly. And then the associated return are positive return for good and okay economy and a negative return for poor economy. So let's see how do we calculate the covariance. Okay, when we calculate the covariance, and we use the probability, we calculate the mean return of each individual stock A and B. We minus the return, individual return to the mean level, and we time them up, or make the product of the 3 elements. Probability of the economy there's a difference. I didn't use the distance. If I use the distance, I would like to say this distance is regardless of the sign. When I say the difference between A and B, that means is A minus B. Okay, this is how we use in the academic paper as well. So with 3 elements here, probability 3.5 times the first element would be the difference between the individual return and the mean return for stock A, times the third element would be individual return minus mean return of the second assets, and we sum them up. That would be the covariance. Okay? But today I'm going to show you another way. I think I probably have already showed very briefly in last lecture, but I'm going to show it again. How do we measure the covariance in a different perspective? When you run the regression, how do we do that? Then you ask the question, I know this method. Why we should run regression? Well, I'm going to tell you why you are going to like to run regression. Why? Because it's going to make your life easier, faster, and much more efficient. Okay, so that's why we always want to have a higher or advanced technology. Okay, this is a covariance one. Last one, I'm not sure it's the last one. Yes, it's the last one. Last one, in order to find her retirement, Megan requires a portfolio with an expected return of 12% per year over the next 30 years. She has decided to invest in share 1, 2, 3 with 25% in share 1, 50% in share 2, and 25% in share 3. If share A, 1, and 2 have expected return of 9% and 10% each year, respectively, of course, then what is the minimum expected annual return for share 3 that will enable Megan to achieve her investment requirements? Okay. So this is another twist. This is the same question, but try to ask you to solve this question from different angle. So basically, we calculate what's the expected return of the 3 assets portfolio. That is identified in this formula. Now we need to understand that that is coming from the probability of the first return times the expected return from the first assets. And how many assets in this portfolio, we have to sum them up. And once we sum them up, we'll find the only thing we don't know is the expected return of the third assets, and that's very easy for us to solve. So I would, any questions on this? I would always take the silence as a green light for me to go. So I'm going to start with a lecture here, a new lecture. And by the way, because I read the lecture notes, mostly provided by the textbook publisher and crafted somehow by my predecessor instructors. And then when I teach for the first class, I feel that I could add in more my own interpretation to have the students understand it more. So usually in the second lecture, and especially on Friday, I would add some information, new information in. And especially for this one, for this lecture, and especially and also for the next, not exactly the next one, is the one on the Modigliani Miller theory. I'm going to add more of my interpretation of the theory to the slides. So please wait for me. During the weekend, I'm going to fully update my lecture notes in this weekend. So right now, this one has a slightly different from what you have already downloaded. So this is just a heads up to give you. Okay, so the risk return in the second lecture. What we have learned last is we know something about capital market line. Okay? We have the horizontal axis. we have the horizontal axis as a standard deviation, which is the measure of the risk. We have the vertical axis to measure the expected return. Then we find something is along this curved line here, and then we can find some market portfolio. So that's basically what we have. What I slightly touched in last weekend, I told you that I'm going to explain it in much more detail in this week. So, and then there's another question here, is the purpose to calculate the variance is try to understand with relatively the same return what we can do to reduce the variance of the portfolio. And we know that by throwing in new assets whose return could be negative correlated with one or several of the existing assets, then we could lower the variance of the total portfolio without sacrificing the average return. That's what we have learned. But there's a question. Once you have moved into that direction, to that far, then someone is going to ask you another question. How much you can lower eventually? Is that possible that you could totally diversify all the risk? No. If his answer is no, why? Well, go back to the intuition. Suppose you can have built a much more complicated portfolio with many more assets where the total risk will be totally disappeared. What does that mean? It's a free lunch world. You have all the return and you have no risk. If that world exists, then there's arbitrage coming in. Okay? So that's a basic intuition on that. And as it's the same as our intuition, that word doesn't exist. So when you reduce the risk of a portfolio with more than one asset, there is some limit that you cannot reduce the total variance of the risk of the portfolio even further. Right now, please pay attention to the word I'm using, variance, variance, variance. I'm keeping mentioning the variance at this moment. And in the next 20 minutes, I'm going to shift my measurement or words of the risk from variance to beta. Okay? It's just a one-word shift, but it's a revolutionary change of our understanding and the risk measure. So right now, we're still talking about the variance of the portfolio. Because so far, what we have learned is about the variance. That variance is only the measure to measure the risk for the portfolio for the single assets. Single assets is variance, standard deviation, portfolio with more than one asset, we measure the portfolio's variance, and within the portfolio, we measure covariance. Right? That's all we have learned so far. And right now, from intuition, we understand there are certain level that you cannot reduce the variance of the portfolio even further. Okay. And now, let me ask you another question here. This is my introduction of the, it's related to the, you can see the question, but please listen me to this question, is, right now we know that a portfolio with more than one asset a portfolio with many assets could lower their overall risk to some level, but not all. Okay? Then I want to ask you the question is, can you tell me the relationship of the individual assets within the portfolio and its relation to the overall risk and return of the portfolio? So far, our knowledge cannot tell that. But you may wonder why I'm interested in that all. right? The question to understand this is coming from the practical world. Is everyone that if we can understand the relationship between the individual assets within a portfolio and the overall performance of the portfolio, what we can do is we can create a huge fund manager industry. So those industry people could pick up, it's called a good stock, and try to avoid that bad stocks, right? So that's another intuitive question. Okay, of course you can think about another one, that's a different method. Okay, so what we're going to do is to answer those questions, then we have to advance our knowledge from the single measure of so-called variance covariance, which is it's Markowitz variance covariance frontier, to the so-called later on is Kappan and Sharpe, what we're talking about later on. This is a key focus of what we're going to do is discuss today. So we're going to introduce the Kappan capital asset pricing model, and we're going to introduce a very famous paper awarded Nobel Prize 1964, Sharpe. Of course, his work was supported by some other famous work, even if they don't get the Nobel Prize, like Linton, the 1965 paper. Okay? So let's start with some academic paved work that we need to do in order to understand the theory here. Let's start with the assumption. We always, in the academic world, we always start with assumptions. So here are the assumptions for the Kappan, the capital market. Investors are rational and risk averse. Okay, when I mentioned the risk averse, I remembered last week. I showed you 3 charts. One is risk neutral, the second one is risk averse, and the third one is risk seeking. I remember, if my memory is correct, that I explained very detailed about what is defined. We can quantitatively define an investor's risk attitude as risk neutral. And then I quickly explained the difference between risk neutral and risk averse. But I buried that question in the end of last week's lecture. I say, please help me to think about an example of the risk seeking. Have you thought about that? Okay, to be honest with me, how many of you really thought about that, even if you resolve the result? Regardless of the result, could you please be honest and raise your hand, please? Thought about that? Don't tell me there's not even one. Okay. So do you think it's a good idea next time I would put some marks on this one? Okay, right now I give you 1 minute to think about that. And if you cannot come up with an answer, I'm going to show you an answer I have. Think about what is exactly you could think of as defined as risk seeking. Why I want to ask this? Because it's possible, those questions are possible to show off during the interview process, okay? If it didn't ask, then it's fine. If they ask and you can answer where some other competitors cannot answer, then your chance will get marginally increased. What is exactly is risk seeking? To think about where you are thinking, maybe I'll give you some clues. Remember what we first discussed about the measurement of risk attitude, about this satisfied measurement versus pay measurement. We're talking about the amount of pay increase associated with your happiness increase compared to the pay reduce associated with happiness reduction. Remember that one? And that is we defined what is risk neutral. And then we can extend it to risk averse. And if it is a risk seeking, then if my memory is correct, please correct me. Someone could still have a quickly flip back to their lecture notes. Is if the investor is risk seeking, then is the pay increase in the same amount. All we're talking about is in the same amount. And in the academic world, we use the word marginal increase of the pay. And if we use a mathematical word to define the marginal increase of the pay, we define it as a 1 unit of pay increase as compared 1 unit decrease of pay. Okay? The happiness associated with 1 unit increase of pay would be significantly higher than the happiness reduction associated with 1 unit pay. Is that a decrease or increase? You see this one, it's a two comparison, okay, two comparison. For some of one that you need to do that, the master degree, the PhD degree, you need to get used to this long sentence. I'm writing a long sentence here. It's part A compared to part B here, okay? Part A compared to part B. Part A is the happiness increase associated with 1 unit of pay increase. This is the whole part is a part A, okay? Compared to what the part B is, the reduction of the happiness associated with 1 unit of pay reduction. And we compare the A and B, which one is larger for the risk seeking? How many of you agree this is a B? Risk seeking. Nobody, okay. How many of you agree this is A? Raise your hand. I see a few. And the rest of them you are indifferent. I say that. Okay, it's A. Why? Because B is risk aversion in that case. Okay? It's totally different. So think about this. Is 1 unit pay of increase is going to associate a much higher happiness increase than the 1 unit of moneyness losses, let's say, associated with your reduction of the happiness. What kind of behavior that is very common that I believe everyone knows this behavior. And that could be defined as risk seeking. Since I already gave you more than 1 minute, right? Nobody come up with, I give you the answer. I believe everyone here know that casino, even if you don't get into that. And gamble in general. Gambling in general is associated with risk seeking. Think about this. You put the coin in the coin machine, right? And $5, $10, do you care about that $5, $10 lose? You expected they'll lose, right? So you lose $5, you lose $10 in the gambling. No, in the gambling machine. It's only in the gambling machine. But if you drop your wallet have $10 in the normal time, you will be very concerned on that, right? At least you are much more concerned than you put the $5 or $10 coin in the gambling machine, right? But what is the happiness if you get a lot of coin coming out of the machine? You'll be very, very happy. You see that one? When you go to step into this casino, you buy the token of $5 or $10. And when you make that decision, and your risk profile already defined that in that moment, you are a risk-seeking investor. Okay? You're a risk-seeking investor. Okay, that's one thing. It's just for you for possible questions in the future pop in today. Investor rational, risk averse. They make portfolio decision in terms of mean variance. They are a price taker. They have identical investment horizon. They have homogeneous expectation. So what exactly is a homogeneous? Same. Very nice. Okay. And perfect capital markets and risk-free security exists. So what I mentioned here homogeneously is in English we usually use some words that is only used in certain society. For example, in the academic world, we have many words we use that are totally different from layman English. Homogeneous is one thing that means the same. If you mean difference, we use the word heterogeneous. We use random as in another word as a stochastic, some sort of the thing that when we have such words in the future, I'm going to explain to you. And once we have this, what we're going to do is we try to understand the return of individual stock as compared to the market. So how do we do that? Okay. In order to understand, this is a regression we're going to look at. But I'm going to pause the display of this one for about 5 minutes. I'm going to start with what we have in last week and all the way to what we have here. So we're about in the edge to jump at the platform of so-called mean variance, that's Markowitz theory, to the sharp 1964 theory, which is the beta theory. Okay, how we can do that? I need to start with a new slide here. Okay. I'm going to start what we have in last week. Okay? Think about this is we have, it's our old world that everybody knows what is going on here. Here is this is variance. This is return, right? That's our two-dimensional world. And suppose you have the first asset, which is a stock A. It's a stock A. And then, in addition to the stock A, you find that there is a second asset, which is a bond. Okay? Bond. And please let me know, because it's an interactive process. Please let me know, in terms of the bond, return, and the risk, where in the graph you want to put it. Let's use north, the upper north, down south, and the west and the east. Which side you're going to put it? It's upper north, it's a northeast corner or southwest corner. Southwest corner. Why? Okay. So far, there is another famous theory. There is a famous theory answer that question academically. So why the bond return should be lower than the stock, and also the risk should be lower than the stock. That's one famous theory on that. It's called the 1974 Merton model. It's option model. It's actually the option model. That's a paper published by Blackshaw after. So we use the Blackshaw-Merton. We use all the three words. But let's say it is right. It's in the south, the west corner. So this is a bond. Okay. So here is bond. So we have the stock A, bond B. That's the two assets. Since we know that we're in the portfolio level, you have the knowledge, so you want to have some portfolio with two combined assets. Okay? And let's see if you combine the portfolio and bond return together. Let me ask you this question here, okay, before I join. This is one combination. That's a two combination. Tell me, which way do you think, because I already marked here in black and in blue, so two blue lines are relatively in the same color, so I'm assuming they're in the same thing. Which one is more likely? You have the two assets. You have both the stock and the bond in a portfolio. Because you put them two together, then I want to ask you, what is the aggregate level in terms of return and risk? The return and the risk, this is measured by the portfolio level. So you have the average return, and in terms of the calculate the variance and the covariance of the portfolio, you need to use all the formula we have used before, right? Which one is more likely? The blue one. Why the blue one? You see that every line that we put onto the textbook, there's a reason for doing that. And to understand this is very important for you to move forward, for everyone to move forward. Why is one? Remember what we discussed here. What is the correlation between the two? How you can get two risky assets. This is a risky assets, right? How you get two risky assets with a suggested risk and profile combination as a black line here? You need a perfectly positive correlation. Remember? It has to be, the rho has to be 1. And we know that in many companies of stock and bonds, that relationship does not really hold. It could be hold is a bond and a stock, they are positively correlated, but not perfectly positively correlated. So rho is larger than 0, but not necessarily equal to 1. So that's why we have most likely, we have the blue line here. Okay? So that's another question. Once you have this blue line versus a black line, even you have the black line here, which one you're going to prefer? Which one you're going to prefer? Let's use the sequence as in my is the 4 on the left, in the middle, and on the right. Somehow, how many of you agree is on the right one? Oh, okay, I haven't talked about this before. Is given, what is the benchmark we're talking about, right? You want to improve. Improve from what? Improve from, let's say, you are a investor. Originally, you're interested in a bond. You're in a bond, interested in a bond. And then the first revolution in the Markowitz theory is someone tell you that, hey, you like the bond, do you? Why you like the bond? You say, I'm liking the bond because it's not very high risk, but not very high return, but the risk is really I'm interested in. That's a maximum risk I could tolerate. Is if the further variation beyond the risk of the bond, I cannot tolerate. And then Markowitz told you what? Look, I can tell you that adding some even risky thing into the portfolio, I could make that portfolio less risky than the bond. You think this is a revolution? This is a revolution, right? How you can put something is even risky than what I have here, and the two combined together becomes less risky. That's the That's the correlation shows up. And what is that? It's here. You know this is the variance of the bond, isn't it? So you go upstairs. You have one point here. You have another point here. Right? And what we can achieve here is any portfolio in this way. Provide what? Lower risk. They provide a lower risk, even than the bond. Remember, right now, it's not just a bond. It's a combination of the bond and the stock. Okay? So that's why we're talking about this is then you have the lower return. You think about this, the red area showed up is not only reduce the risk, but also what? But also increase the return. Compared to the bond. So our benchmark is actually to the bond. Right? You say, no. I'm a very aggressive investor. I really like the stock return. Right? But what we could tell you is, to compare the stock, okay, follow my argument. Now you think about, right now it's an interview process. People asking you, give me the rationale why the stock investor also prefer the portfolio like this. They also like the portfolio that is combination with the bond. Why? That's the only choice. We're talking about the only choice is the rational. If you're rational, that's the only choice. Count down 30 seconds. Count down 25 seconds. Count down 10 seconds. Time is up. Who wants to volunteer to answer this question? Okay, I give. Okay, I volunteer. Why? Because for the stock A, not only we have to consider return, but also we have to consider the risk. That's so-called Sharpe ratio, right? Valuating an investment is not purely about the return. It's far beyond that level. It's about value by the risk-adjusted return. Remember these three words. Risk-adjusted return has to be in this way. Once you get the college degree in the business school, you have to speak about the language like this. You cannot just talk about the return. We have to talk about the risk-adjusted return. Okay? So in this case, stock market return also prefer a combined portfolio. Okay? Because they lower the risk. Although you load, then it becomes what? It becomes the blue line here dominate the black line here. Dominate the black line here. Okay? And as you can see here, is not only just the two blue line dominate the black line, but also the left-hand side, the blue line, dominate the right-hand side blue line. Why is that? Why is that? Remember this one? I marked this as 1. I marked this as 2. Compare the 1 and the 2. They're the same risk. But the 2 provide high return. Is that right? Compared to 1 and 3, they're same return, but they're lower risk. You see this one? So even on the blue lines here, two blue lines here, the fall on the left-hand side, the blue line, would dominate any blue line on the right-hand side. This is because risk and return. Same risk, higher return. Same return, lower risk. Okay, this is only two assets. Think about I throw hundreds, thousands of assets into here. Then each combination, we're going to have this kind of a blue line, two blue line. And then eventually, I need to file another one, is we are going to use, I need to add another slide here. New slides, here. Okay, right now we have same thing here. Return, variance. Remember right now, I'm always writing to this moment, I'm always writing the risk as a variance. But right now, because we know there is, if you throw thousands of assets into what we have done the exercise before, we're going to find the ultimate blue line over there. Let's write that ultimate blue line here. That's the ultimate blue. Okay? Right now, think about this. Thousands of assets, right? This is the ultimate blue line, the two conditions so far. Let me ask a further question. Based on what we have discussed so far, let me use the black dot to show any possible asset combination along this part of 1,000 assets portfolio. And please answer me the question. So I have three possible selection here. One selection is the asset combination Okay, one combination is like a black cross here. Okay? You can select any of the black cross. The second combination is along the blue line here. And I'm going to give you a third combination, which is tell me which one is your preferred investment decision along the blue line. Give me the rationale. Why you don't like the black cross over there? Yeah, as we discussed before, right? We use the two assets here. Anything, because right now this blue line here is the ultimate the blue line. We combine, we expand from two assets to thousands of assets. So this is the most efficient, it's a dominant one, right? It's a dominant one. Therefore, any assets in that black cross here would be inferior, or less preferred. In what perspective? In risk-adjusted perspective. Then the blue line here, the combination of blue line. So blue line is here. But let me ask you the third question. Is that possible for your asset combination? Is that possible you can achieve something that in the green cross here? No, you can't. Why? Well, let me hold that as a possible comments. Why? Because no. The answer is no. Why? Because we already put all the assets we could exhaust it in here. And the best combination is along the blue line here. There is no possible way that we could achieve that return beyond the blue line here. So that's why the blue line is academically defined as efficient frontier. That's the most efficient you can choose. However, right now I tell you, the green clause cannot be achieved on one condition. All the return, the assets we're talking about are risky assets. Are risky assets. Okay, how to achieve some combination along the green clause here, which is, in general, the green clause means you can go beyond. Right now, the blue line is already efficient frontier. That's the most efficient you can do with the risky assets combination. But people really want to go is that possible that I can go even further? So far we can't with the risky assets. But next one we find out, and that's how Sharpe make a revolutionary change of the way become the Nobel Prize winner, is we can achieve this green cross here. By doing what? By doing introduction of risk-free assets. Once we have the risk-free assets, then we have somewhat. We have something like this. Let me erase all this first, okay? This one are all gone because they are not our preferred. We can also do this. Let me tell you how we can do that. Is we started with the risk-free assets. And according to our understanding in the last week, we combine the risk-free assets with a somewhere portfolio here. I can achieve something during the red line here from this point to this point is what we could achieve, right? So what is this segmentation? Let's erase this first, okay? Let me carefully erase this one first. Because in order to do that, we need to use leverage. Tell me, how is the risk-return profile in the red line here compared to any point on the blue line here? Well, that's easy. Like we say here, think about this. The two cross here, combine A and B. What's the difference? A and B share the same return, but A deliver much lower risk than the B, right? Okay, if something like this is possible, how we can get that? You see, this is possible, right? This is possible. This is intuitively possible. How can we get that? You see that originally anything on the A in the red line is not possible. And that's the theory boundary of so-called efficient frontier. That's Markowitz mean variance variation. Mean variance analysis, that's the boundary. The boundary only tells us the blue line is the best you can get. Anything on the right-hand side is inferior. Anything right beyond the blue line is impossible. This is how that mean variance theory tell you. But right now, Sharpe tells you that let's change the combination of the assets with a small twist. Let's add in a risk-free assets. We can achieve even better. And this better comes from the risk-free assets. Now we can achieve something in the line, for example, in the A point. Okay? But this is the vision, understanding of the CAIPAN theory. Let's move back to the scientific one, that how exactly Sharp and other scholars have showed us scientifically why this is possible. Okay? Let's start from this. So what they can do here is they collect because this is a very interesting, right now it's 10 o'clock. How many of you need a break here? Okay, if you want to break, I'm okay. Let's take a 5 minutes break, and then we come back, okay? So it's exactly the good time to talk about this. Okay. Okay. Let's get up. Okay. In the first hour, we have demonstrated how it is possible to make a jump from the Markowitz mean variance frontier, efficient frontier, to a place that we cannot even thought about before. Because Markowitz has already told us evolutionary that you can reduce a portfolio's risk by adding assets that could be even riskier. We showed that, how to achieve that. But once Markowitz frontier has been formalized, then we know what it is a frontier. It's the best solution we can have. It's along that blue line here. Anything that is on the right-hand side of the blue line, it's less preferred as anything along the blue line. But the limit of Markowitz mean variance analysis is there is not possible with all the combination of the risky assets. We can achieve anything in terms of measured by the portfolio return and the variance that is even better than the efficient frontier, which is in the blue line here. Here is Sharpe's contribution. He said, look, we can't do that. We can't do something like in the red line here, especially we can compare that A, the risk and the return, is even better than the B. But we need to know how they can do that. This is how do they do, how did they do to make the paper published and then won the Nobel Prize. This is exactly what they have done, but I will narrow it in a way that undergraduate students could understand. Think about this. You can do this. You can repeat this. Download the stock return. Download the stock return. Okay? All you need to do is download the one stock return and one market return. Let's say the market return is Stanford 500. And the stock return, let's say it is any company you are in your favorite selection. It's a one stock, one index. You download the daily return. So in 1 year, there are 255 trading days in America. You download for a number of years that make you feel very comfortable that you could run regression without a small sample, subject to the small sample criticism. So let's say in the asset pricing, we usually download 5-year data. Daily data, weekly data, 5 years. Okay, with 5-year data. And then, you know what is the horizontal axis? It's the market return. The horizontal axis is market return minus the risk-free return. You have downloaded the third part, which is a risk-free return. The risk-free return, U.S. Treasury 3 months. You can download from the Federal Reserve St. Louis's website. And that risk-free return could also use to measure the excess return of the stock, which is, that's the stock. Okay? So you download the 3-time series in 5 years period, stock return, your favorite, And market index and risk-free return. Think about the 5 years, you download all this, and then what you do is you create the dependent variable. This is your dependent variable. Let's use the dependent variable as y, right? And the market return that you measured here is an independent variable. Let's use that one that we are more familiar with, x. Okay? With the y and x, you put it into the spreadsheets, and you can run regression. It's very simple, right? Very simple. You run regression, and once you run regression, you come up with alpha and beta. Okay? What does the alpha beta mean? It's going to be slightly delayed. But let me first give you the scientific definition of the beta. So what is the scientific definition of the beta? The beta here it's the covariance of the stock, R1, and the market return, each stock. This is an individual stock. So this is stock. And this is market divided by market variance. And if you further use that we have learned in the previous lecture, the covariance is equal to correlation times the variance of the stock times the variance of the market portfolio divided by, standard deviation of the portfolio, standard deviation of the stock return, and divided by the variance of the market return. And then when we cross out the market standard deviation, then the beta is equal to the correlation times the sigma of the stock standard deviation divided by the standard deviation of the market. That's the beta. Okay? So what does the beta tell us is, go to the next page, is the stock return. Think about this. You move the risk-free rate in the red box here on the left-hand side to the right-hand side, okay, to the right-hand side. Then you got this formula. Is that right? Any doubt? No doubt? Why no doubt? If you have, please say it now. The tricky part here is, let me repeat what we have right here, okay? Oops. Hold on. I can't do it better. Okay. So minus RF equal to alpha plus, should have an I because beta I times ERM minus RF. That's one. Original regression. This is our original regression, right? It turns out to be when they run the regression, it turns out to be there are two pieces of information we need to add it in order to move to the next one. The first one is this one. It's infinitely close to 0. And the second thing here is this one has a t-value large than some threshold. let's say it's 2. Okay? So statistically, we understand that alpha is not significant. So we can drop the alpha. It's not a difference from 0, but the beta is significant, so we keep the beta. So once we have this, we can move the risk-free rate from left-hand side to right-hand side. We can move this part to this one, and then we have the next solution. So what does that mean? The beta here, let's go back. Let's go to this one. The alpha and beta here is the beta, it's the slope. Oops. The beta here it's the slope. And if the alpha is equal to 0, or very close to 0, or indifferent from the 0, what does that mean? And how can you show it in this chart? Where is the point to show where the alpha is? You see, it's beta equal to, suppose here, if the beta is equal to 0, think about this. If the beta is equal to 0, then the y, which is measure the risk-free return, right? So they think about the beta is equal to 0. You need to measure the red box. That stock return is how much? It's measured by alpha only. Because the beta right now is equal to 0. You got this? Beta right now is equal to 0. Then all the excess stock return for the variable of y in the red box is purely measured by the alpha. And if the alpha is indifferent from 0, where the alpha should be in the chart. So the beta is equal to 0, stock return, which is in the red box, that's alpha. And it's indifferent from 0. You see that? You cannot say that it's, well, it somehow is not exactly 0, but when they run the regression, it's indifferent from the 0. So this is a correct chart about the CAPM. And I spent quite some time to find this chart. Some textbook, if they write, you have to plot the chart like this. Because if otherwise the chart is much higher than this, then it's wrong. Because in the CAPM world, alpha is equal to 0. Or statistically equal to 0. Statistically not different from 0. That's a CAPM theory. Okay? Okay. So what we can see here is make two connections here. One connection connected to the sharp Markowitz, to the Markowitz efficient frontier. The other one is going to help us really understand what's going on here. Okay? First of all, we can make a new investment by adding a risk-free assets. Let's go back to the next one again. You show this one? Is we can make a new investment by adding a risk-free assets. And then we can combine the stock return of the market. Then we can increase some new portfolio. What exactly is a new portfolio? It's actually one of the stock return within the portfolio. And the stock return is combination of two. This is the main part. And this is a constant part. This is also constant, or let's say the same. This is also constant. What is different, as you can see the subscribe here, the key point is the subscribe. The subscribe shows that individual stock. So what exactly is the individual stock return? The individual stock return is coming from the market access return, which is coming from the green box here, the green box. Let's erase this one. The individual stock return coming from two parts, two elements, or two pieces. One piece is coming from the risk-free return, but the risk-free return would be in the market for all stocks. So all stocks will share the same first element, which is risk-free return. But what makes the stock return different from each other, one another, is the stock return has the second elements. And if you look very carefully about the second element, is the market risk premium we define here. It's a market return minus risk-free return. And we define this market risk premium. It's the same exactly for all the stocks in the portfolio. But why we could observe different stocks have different return? It's because each different stock has a different beta here. Each different stock has a different beta here. And because the betas are different, so that's why the stock within the portfolio, they're going to show the different return. So you see why the shop, the paper by the shop, provide a much more insight than we understand from the efficient frontier. So efficient frontier tells you, look, that's the best you can get. And the shop say, no, we can make two additional contributions. First contribution is we can achieve something that is even better than the efficient frontier. By doing what? Very simple, add the risk-free assets. That's shop said the first thing. The second thing is, even more, we can tell you what's the relationship about the individual stock return and the market return. And how we're going to do that? We're going to show that is individual stock return is actually coming from where? It's actually coming from the market risk. It's not from the risk-free return. Why? Because each risk is the same risk-free return. We're going to factor all the stocks in the same magnitude. But the risk or the return, right now, we almost combine the risk and the return together, but we have not yet. Okay? It's the return coming from the market risk premium with a significant so-called beta here. And the beta, we call this is exposure, their exposure. And each stock has a different exposure to the market. And that's why we have a different. Okay, so once we have this, then we could quickly move on. And then we can understand this is risk return of the portfolio, risk return of the risky security, which is equal to the part. And we put the definition of the beta here. The beta is, so this is the beta. So this part is the beta. Right? That's the beta. Okay. Now let's look at this. Remember this one? We draw the line before, but right now we change this one to the beta. If you notice that, this one becomes the beta. It's once we're in the shop's world, in the world of shop, the risk measurement is not from the perspective of standard deviation variance anymore. We're talking about relatively risk. How to measure relatively risk? So all the risks are measured aggregatedly by the market portfolio. Why there is a market portfolio? Because, remember last time we have this chart here. We noticed that somehow in the mean variance world, there's some risk is no matter how many assets you throw in, the portfolio risk cannot be reduced to zero. What kind of risk is that? It's systematic risk. It's market risk. You cannot diversify them all. Then how to explain the individual, and the market is what? Market is an aggregation of the individual assets. In the Markowitz world, they cannot explain the relationship of the individual assets and the market portfolio. In the Sharpe's world, they can explain it very clearly and convincingly. What is that? It's the return of the individual assets and the market portfolio is because they have the beta relationship. So you see this one? So right now, the security market line is mostly coming from the Sharpe's world. And the capital market line is mostly coming from the mean variance world. Okay, let's do one small example here. Assuming the asset A has expected return of 9.4 with a beta of 0.8, and asset B has expected return 13.4 with a beta of 1.3. If two assets are correctly priced on the security market line, what is the return of the market portfolio? What is the risk-free rate of return? Okay, let's see how we're going to do that. How we're going to do that. We just follow the theory, right? So we have expected return. The I is equal to RF plus beta I times this R market minus risk-free, right? And in this expression, I is equal to A and B. So we list the two equations here, A and B, and we have two unknowns here. So we can solve the two unknowns with the two equations, right? So that's pretty straightforward. Now let's look at that one. Portfolio beta. Remember the difficulty in the mean variance world that we need to measure the portfolio risk by the standard deviation or by the variance. How difficult is that? We need to get all the information in. Either you need to know the rho, or need to understand what's the probability. You need to calculate the mean of each return, and you need to calculate for each assets. Think about this. In a portfolio manager, you manage like 5,000 stocks. And you need to, every day, you write Excel spreadsheets, or even you punch the calculator key. You need to punch in the 5,000 stocks information in the calculator. Right now, when we run regression, we put it into the two columns, and we just need to press one button in this Excel spreadsheets. We can get this coefficient. How efficient is that, right? And then the portfolio's beta, according to the regression, is additive. It's a weighted average of the, so it's much faster, it's much efficient, right? Okay, let's see the second one. ABC has 3 divisions with equal amount of assets, and the beta of the manufacturing division is 0.75, and the beta of the retailer division is 0.8, and the beta of the high-tech division is 1.36. What is the beta of the ABC? It's equal weighted, right? It's equal weighted. Sorry. It's equal weight. It's amount. Okay, they're using the equal amount here. So that's equal weighted. You put the beta and the weighting together, then the ABC the company's beta would be calculated. But there's another question. Suppose ABC plans to expand its high-tech division by taking a new project. Which beta shall we use to evaluate this project? Which one? You tell me. Can you tell me? High-tech, retailer, manufacturing. It's a high-tech project. Right now, we measure the risk. You need to use the same risk coming from the same department to measure another project which is supposed to be in this department. So in this case, you need to use high-tech. So this is you need to use a high-tech division to measure, right? Okay. So that's easy. Let's keep moving on. Oh, here's a question. We have discussed so many differences, and I call it this is the jump. So Markowitz's word already told us the mean variance. And Sharpe say basically provide relatively the same charts. So what's the difference here? And why the Sharpe also they get the Nobel Prize? Well, here's the difference here. Okay? Don't get B. In the Sharpe's word, we can also have similar charts here. We can also have the charts here. So the chart graph is the same. The two graphs are exactly the same. Okay, tell me which one is capital market line CML, which one is the security market line SML? Okay, remember, the CML, capital market line, CML. Security market line, SML. So what exactly the difference is these two? Is in the capital market line, we're talking about aggregate risk. How do we measure aggregate risk? We measure the aggregate risk by calculating the mathematical formula of the variance. Okay? And in the security market line, we measure the risk by beta. What exactly is beta? It's a relatively exposure to the same risk source, which is a market we're talking about. So there, you can measure the risk by two different ways. Okay? One way is you use standard deviation, mean variance analysis. It's called a mean variance analysis. That's a standard deviation on the return. That's one way to measure this one. But there's a second way, which is right now becomes a very start point for all the modern financial academic and practitioner to measure the return and the risk. Return, you can always calculate it from the market. And then you have to measure what exactly is the relationship between the return and the market return. How do we measure that? By the beta. Why we need to do that? Go back to another question. Right now, there are wealthy people here. They have the money. They want to invest in the market. They really want to know what kind of stock would going to give them high return. Right? Think about this. Suppose next year the economy is going to do pretty well, let's say, in the United States and in Australia. Okay? And there's a wealthy family here. They have $100 million, the US dollar, they want to invest. There are 3 stocks over there. Suppose you have the 3 stocks. That's the only 3 stock selection you have. And by measure the past several years beta, stock A has a beta of 1.5. Stock B has a beta of 1.0, and stock C has a beta of -0.2. First question is, let me know, is that possible that the beta would be negative. Why? If it's yes, why that's a yes? If it's no, why it is a no? Think about the question I said in I think in the last week. Remember, there are some stocks that are negative, correlated with the market. And the beta basically is measured. So where is the beta come from? Beta scientifically is measured by, let's see, go back. So all we discussion are based on, what is exactly beta? Here's the beta. See, this is the beta. That's the beta. That's the definition of the beta. Sigma, always positive. Market, stock, always positive. The rho could be negative. What kind of rho we're looking for? The market moving up, the stock is return could going down. But when the market drops, the stock could perform much better. That kind of stock we're talking about. So beta could be negative. Okay? Let's go back to the other question here. And once we have this one, you have 100 million to invest, and you are in a 3-stock world. 1.5 beta for A, 1.0 for B, and negative. Let me revise the number. Negative 0.5. Why I want to revise from negative 0.2 to 0.5? Because the market beta is equal to 1. Right? Okay, it's equal to 1. So 3 stocks, 1.5, 1, and negative 0.5. There's 3 stocks. On the condition, you have to do it on the condition. When you expect that the economy is going to prefer very well next year, which stock you're going to choose? 1.5. Why? Because you want the return, right? You want the return. You want the high return. And 1.5, the same risk coming from the market. The market risk is the same. Risk-free risk is the same. The only thing you could select from the 3 is coming from the beta. And 1.5 beta gives you market return increase 1 unit, and your stock A return here, because its beta is 1.5, it's going to increase 1.5 unit. Okay, that's one condition. The second condition, expectation. The economy is not going to do very well next year. We're expecting the market is going down perhaps 2%. And you have the cash here. You really want to find some investment opportunity. Which stock you're going to invest? Same 3 stocks. Say it again. The third one. The third one, negative 0.5, right? Because the market return go down, your stock could go up. Okay, there's one. Why the shop going to be very famous here? There's another. Think about this. In Markowitz mean variance world, think about this. You are a wealthy family, and you have 100 million to invest, but you really don't know, or you're kind of like a hands-over strategy. You want to hire a portfolio manager to do the job. You want to hire a portfolio manager to do the job. There's 2 portfolio managers come to you. Okay? Which one are you going to choose? In the capital market line, mean variance, you cannot really compare. You can try, but once you follow all the academic evidence all the way down here, you cannot make a decision. Why? Because you always need to compare risk and return. It's almost impossible. But in the security market line world, Very easy, very simple. All you need to do is run their historical return of their portfolio against the market. You get the beta. And you need to choose high beta, low beta, depending on how you expect the market is going to perform next year. Simple. You see? So many things. So that's why there's a difference and connections between the two. Security market lab divided by Sharpe is purely based on what we already know in the mean variance framework that is designed by Markowitz. But it's going to tell us much more than the Markowitz mean variance, the word. So there are a lot of candidates. Okay, we finished talking about this, the two words, the CAPM word. Let's talk about the risk-free line, interest rate. Well, empirically, risk-free interest rate. Right now, okay, so far what we have done here is any questions, if you have, you can ask me without any problem, okay? What we have discussed so far is purely from theoretically perspective. Right now, we're going to dip our hands into the empirical world, okay? And then I'm going to show you some shocking surprises, okay? So how do we measure risk-free interest rate? Well, there are 3 months US Treasury bill. In Australia, 90 days government bond. And then how do we measure beta? Well, we can measure the beta by the, you think about this is the covariance of the market and the portfolio divided by the variance of the portfolio. So this is how we measure the beta, okay? And also we can run the regression. When we run a regression, the slope is the beta, okay? Beta is the slope term. So this is a, remember the beta here. When they run the regression, the beta is the slope of the regression, okay? Okay, let's go. Okay, now we're going to approach in a very difficult empirical question that the CAPM theorists try to answer. How to define market portfolio? Well, according to CAPM theory, market portfolio should including all the investment in the market. But empirically, how do we define that? Well, people started with, in the US, Stanford 500 index. In Australia, there's some index over there. Then what they find out is when they try to use those benchmark like Stanford 500, Australia index, they're trying to run the regression to show the CAPM or to prove CAPM, they find the shocking news. What they find is CAPM didn't work. CAPM didn't work. It's a very simple regression. So what did Pharma French first show that is when they run the regression, it's a famous paper. This is a very famous paper. Pharma French 1992 and then 1993. What they find out is it's a stock return. This is individual stock return. It's equal to, this is what I find. Let me write it very carefully. Minus risk-free return is equal to alpha plus beta I. Remember the I here. Times the return on the market minus return on the risk-free. And what they find is there's 2 more elements here. And beta, let's say J no, this is still I because it's a stock and 2, because right now this is a different times called SMB, and then there's another beta I3 times H and L. Okay, so what the first find is if the CAPAN is what we find it here in the CAPAN world, and which I use the red line, the blue line here. So in CAPAN world, this one should have gone. This one should have gone. This one should have gone. That's in CAPAN world. And the beta here is the only source of risk. We have different exposure. In formal French, '92 and the subsequent '93 paper, this is what they find. They find this is there, but it's less of concern at this moment. And later we're going to talk about the alpha first. This one becomes 0. And this one, significant. And this one, significant. So that's why, let me tell you, that's why when Formal French first published this paper, both of them worked in University of Chicago, go back to 1992. It's so shocking, the academic world. Why? Because the paper totally turned the CAPAN theory upside down. Because CAPAN say the alpha is less of the concern. We are not going to discuss this at this moment, but in the next 10 to 30 minutes, I'm going to discuss alpha again. It's a very important one. Alpha should come, let's say, forget about this. The key point here is the beta here. The beta here, beta I in CAPAN should be the only source of risk. But in the Formal French, their regression showed up. The beta is statistically indifferent from 0. It's not exactly 0, but the t-value is very, very low. Okay? But what it shows up is there is a beta to the so-called SML and HML. High minus low, small minus large. Oh, yes, SML. What is SML? Is small minus large. What is the HML? Is high minus low. So what they're going to do is they follow the CAPAN to use the stock return identified as small stocks in the previous, say, 6 months, minus a large stock return, and create a so-called a factor. Okay? And they use a similar method to create a high, which is the growth. Firm could be measured by the growth rate. High growth rate minus low growth rate firm. And create a 2-factor. And what they find is the 2-factor take away all the CAPANs. And originally when they run CAPAN is marginally or not significant. So this is create a huge stir in the academic world. Why? Because CAPAN theory, it's so simple. So it's purely based on more risk, more return. You cannot turn this upside down. You cannot say the return is coming from the thin air. We cannot say this. You have to put in some efforts in order to harvest anything. That's very, very basic. And that's exactly CAPAN says. But what the empirical world tells us is CAPAN didn't work. So when they published, let me tell you the story. Okay, it's sort of the story of the academic world, the development. Is after the 1992 the paper and then subsequent 1993 paper published, academics are doing a huge amount of work trying to prove formal French is either run on one stream or on the other stream is do ad hoc. What is ad hoc mean? Means what you find does not have a representative pattern. So what I mean is you find something is very unique, but you cannot you cannot repeat that kind of pattern in somewhere else. So in the next 10 years in general term, next 10 years in general term, is academic thousands of paper, right? Some of them can be published and try to show that whether formal French could also work in different time period in the United States or in other countries in different time period. And you know what? After thousands of paper has been written, what's the result in general? They find that they cannot discredit formal French, the findings in the formal French 1992-1993. Cannot discredit. They all could be repeated in different time period in different countries. Okay, so this is the first one. And we know that in the Anglo-Saxon world is if you cannot beat them, then do what? Join them, right? From skepticism becomes a follower. What are the followers trying to do? Well, Kappan is a one-factor model, right? It's a one factor. This is called a factor. You can call this is, let's say it's a factor. And that factor could including so these are the factors. Market is a factor. SML is a factor. HML is a small minus, oh, it should be small minus big, sorry. I just, small minus big. Okay, small minus, SMB, yes, that's, and high minus low, yes. There are factors. And those factors, if you have two, can we construct a third one, or in the formal French word, it becomes a fourth factor, and then also spend 10 years. What they find is a 1997 cohort paper. Find a so-called momentum factor. So what they use is, they use stock in the previous quarter months with high momentum minus low momentum, and they find that. And after that, you know what? It's what we're going to discuss in the real world. Is the fund manager industry start to hire a lot of PhDs from the academic world. So what the PhDs are share the same thing, we read the paper. So what we're going to work in the fund manager industry is we just follow exactly what the formal French paper tells us, and we select the stock. We value the stock based on whether this is a high minus small minus big, high minus low, that kind of stock. We define the stocks as a high growth stock, low growth stock, large stock, small stocks, like this. Okay? Then we create the factor, and then we put into the regression we run. I will choose that the stock with a high return, and we invest in our portfolio. What they find is, after so many years that the formal French has published this paper, that right now is more than 20 years, we find that the momentum factor disappeared. Why? Because the momentum factor is more ad hoc. It's once that factor shows up, it's arbitragable. It's arbitragable. What we really want to find is cannot be arbitraged away. That's what we really, really want to find. Is everybody follow that? Everybody could repeat that. Everybody could get a positive return. And that return will be persistent over the time. And that's really what the theory want to find. Okay? So let's talk about a little bit more. Okay, the market, so when they find that the former French find this, then there's a huge debate say, well, the market may not be efficient. Well, once they say market is not efficient, that's going to create a huge backfire from all the theorists. If you say the market is not efficient, now let's say, what's your alternative hypothesis? What is even more efficient than the market? Then those people cannot make any single example on this. So what they can do is they keep moving on. The debate lead to another one called arbitrage pricing theory. So what does arbitrage pricing theory says is, investors are rational and risk averse. Security return have a linear factor structure. There are a large number of the security and market permits no arbitrage opportunity. And all you need to do is consider different, it's a different risk factor. Yes?
Sorry, I just have a very basic question. So out of these three, which one are we supposed to be focusing on for the exam, for the quiz? Because there are three very different formulas.
Which three? Which three?
So the first is the FF, then you have CAPM, and now you have...
Say, first is what?
The CAPM.
Okay.
Then your FF, what you just spoke about now. And then you've got this arbitrage. So which one are we supposed to be focusing on?
I would say that at least you need to understand the CAPM.
Okay.
But I always expecting a good performance students. I hope everyone is motivated to understand as many as possible. So it all depends on you. CAPM is a very basic, right? But if you're in the interview, your other colleagues fellow students could identify, show what's the problem with CAPM, with the formal French. And if that's correctly described, then I would guess that the other one will have an advantage over there. So it's totally up to you. To my understanding, is CAPM is very basic. But I just want to push you up a little bit for you to understand what's a development in.
My question is, do we need to remember the formula for the other two? This one and the previous one.
Well, everything we described in the lecture will be on the test manual. That's the basic what I have told here. And the formal French is in the lecture notes. It's a case risk factor. So their APT here is a different risk factor. And we showed here which is formal French 1993. So everything here, yes, we follow. I had a chart with the department chair. In the first few days, as we mentioned here, follow the general rule in the Monash is everything that we discussed in the lectures and put on the lecture notes will be on the test manual. So this is, thank you for bringing up that question for clarification. Okay, so this is to show you have a different factors here. And this one shows the momentum factor. It's a momentum factor. And the understanding of the momentum cohort model in 1997 could be arbitraged away. Okay. The next one is the reason that the momentum factor could be expected to be arbitraged away. It's the finding we have. And now this is going to raise a question for all the academic and practitioners to understand why that momentum could be charged away. could be arbitraged away. Then that's lead to another question here, which is interesting, is how do we analyze fund managers' performance? Fund managers, they have the investors transfer the portfolio decision to the professional, the managers, by the exchange of the fee for their expertise. That's probably the fund management industry is doing for. So the investor's expectation is to generate above average return after adjust both the fee and the associated risk. And the fund manager's return would depend on, well, first of all, if they read, they would have the risk factors. And if the risk factors could be further linked to either the market performance or the other part would be skill of the managers. Therefore, as we know from the Kaplan theory, that we know the stock has different exposure, but the skill to pick up individual stock would come from the manager's skill. For example, as we discussed before, when we're expecting economy is going to doing very well next year, the skills of the manager would show up to pick up the stock with relatively good, the higher beta. And that's how we can find that the different fund managers, their return could be very different. But how to quantitatively measure those returns, that would be another question we could rethink about the Sharpe ratio. So the Sharpe ratio, originally we discussed, is the return of the portfolio minus risk-free return and divided by the standard deviation of the portfolio. That's originally. But once we understand that this is possibly to achieve through a Kaplan's work, then all the risk measurement are all coming from the betas measure. Then we could think about there is another possibility we could measure the Sharpe ratio, which is coming from the this is still coming from the standard deviation. This is still coming from the standard deviation. And that standard deviation is by the Sharpe measure. And once we understand we can measure the risk by the beta, then we can use the beta to replace, use the beta to replace the standard deviation of the portfolio. So once we have this, then we know that we can measure the different fund managers' performance based on how much beta they have. This is called Trenor measure. So this is equal to the risk premium per unit of systematic risk exposure. The higher the Trenor measure, the better the performance. The Trenor ratio focuses on the systemic risk only and do not consider under diversification of some of the portfolios. Now let's talk about, as you mentioned here, is there is even not just the three. There are additional formulas for us to teach. It's called the Jensen's alpha. So what is exactly the Jensen's alpha? So Jensen's alpha is coming from the same regression. Let's rewrite the Kaplan's model. Okay? So we have I here. Minus risk-free is equal to alpha plus beta I times R Rm minus Rf. Okay? As we said before, the beta should capture all the risk, and in the alpha should decrease to 0. But Farmer-French, in the 1972 paper, they did show that alpha is not equal to 0. Then during their work, they mentioned that Jensen find out that this is an interesting thing. So Jensen put that same regression in the fund manager's industry and come up with so-called the Jensen's alpha. And this one should be as a subscribe as I. So all you need to know is put the alpha, do a little bit of manipulation on this, then you can, the whole equations is you can get the Jensen's alpha. Okay, what does the Jensen's alpha say? Let's go back to our understanding of the CAPAN again. If the beta is equal to 0, let me ask the same question again. Right now, the beta is equal to 0, and the alpha is not equal to 0. What does that mean? All follow what we have learned so far. Beta equal to 0 means the investor or manager's exposure to the market risk is equal to 0. There is no exposure, right? This one, beta, is equal to 0, then the manager's excess return, which is identified by the RF minus the return minus the RF, risk-free interest rate, is all coming from where? Coming from the alpha. So what does that mean is the portfolio manager, their return has 0 exposure to the market risk, but they have extra return. The extra return could be positive, could be negative. But let's now think about the extra return is positive. And then what do you think the manager would be? In order to help you to understand, then I have to extend it to Farmer-French three-factor model. Okay? From this one to Farmer-French three-factor model. So right now, we have extended the Jensen's alpha. Sorry, I write here. Is I minus RF is equal to alpha beta I1 times Rm minus Rf plus beta I2 times SMB plus beta I3 times HML. And we know that in the Farmer-French three-factor model, this one close to 0, this one works, and this one also works. That's what we have now. Farmer-French three-factor model, 1993 model. So what Jensen called this is, let's see this one. Even if, so the fund manager, when they have the return like this, it's already showed that the fund manager read the academic literature of Farmer-French three-factor model. So they selected the stocks based on their understanding of small minus big, high minus low. They already selected the stocks. That's in the regression we say, after we control all this, we controlled all this, the manager could deliver extra return. extra return. What does that mean? Tell me, where does the return coming from the blue box here? In order for manager to deliver the return in the blue box, the manager needs to know the Former-French three-factor model. And where does the three-factor model coming from? They need to read, most of the manager, they know the three-factor model, they need to have a PhD here. So this is the education factor. You do the PhD, you read the paper, you really understand, you replicate the paper, and then you can deliver this kind of return in the blue box. In the blue box. But what is even more, someone not only just know any information in the blue box, that knows extra in alpha here, that's not coming from the education. That's coming from the skill. And that's kind of unique. And it's unique, difficult to learn or to copy or to replicate. That's the most important factor for the fund manager industry to be valued, that has been valued in the past 20 years. Okay? It's called the Jensen's alpha. The fund manager's skills beyond the education, which is coming from, it's represented by the Former-French three-factor model. So think about this. The second line here is the return analysis in the same way that we talked about before. You download the return of a fund manager in the past 5 years. You construct the market portfolio in the 5 years. You construct the Former-French two other factors, small SMB, HML, 2 factors in the past 5 years, you run the regression. That's all you need to do. Once you run regression, as long as you find the alpha, which is significantly different from 0, and you know this is a manager's skill. Why? Because all these returns are first controlled by the market beta, then controlled by Former-French three-factor. Okay. Right now, we talk about the return. We know that return is positive. Okay? Return is positive. That's the beta. You see that the beta here? It's a beta and the market portfolio. Now we want to ask the question is, if the portfolio manager could give a higher alpha, we would normally say that the portfolio manager is going to have a better skill. Okay? But let me ask the question in a flip side way. A flip side way is, if you are a boss of a fund manager company and someone come to you, say, they have a history, they generate alpha, which is negative, but it's significantly negative, which means this manager always losing money, always losing money in the market. The question is, would you consider hire him or her? And if you do, why you want to do that? And if you hire him or her, how you want the person to handle the portfolio in your company? So there's a negative alpha over there. But the negative alpha is significant, persistent. Okay, the decision based on whether you want to help people or not is based on whether they can provide further information that you can make more money. And his history, his or her history, the person's history, clearly identify the strategy was in wrong direction. Okay? But the wrong direction also is valuable. Why is that? Because in the future, if the manager go to sell the stock in the future, and you know that you should buy them back. Okay? You just the opposite direction. So what you're going to do is you're going to still hide this one, but let the person handle a very small amount of the money. And the person is going to show you what the strategy is. And everything the person is going to buy, you're going to do the other direction with a large amount of money. And that's why the industry is doing. So even if the negative return is also valuable in the market, okay? But it has to be persistent and consistent, okay? Has to be this one. So the measure is known as a Jensen's alpha. It's a fund manager's excess return over the return predicted by the, it's called not just SML, but also small minus large was HML and SMB. Positive alpha means the fund beat the market, and the higher the alpha, the better the fund performance. Jensen's alpha focus on the systemic risk only and do not consider the diversification of some of the portfolios. A public pension fund holds a portfolio of the stocks with realized return of 12%, the beta of the portfolio 0.8, standard deviation of the portfolio 0.9, realized return of the market portfolio is 15%, and the risk-free rate is 4%. Calculate the Sharpe ratio, the Treynor ratio, and Jensen's alpha of the portfolio. Then we just follow the three formulas in the slides. There are several discussions here, but it's much less. So the most important part will have already been covered. Right now we have a few wrap-ups we have to do. It's comparison of the Sharpe versus Treynor versus Jensen. So if the portfolios are fully diversified, the ranking will be relatively similar, especially the Sharpe ratio and Treynor ratio will be identical. The appropriate performance measure depends on the role of the portfolio to be evaluated. When you use the Sharpe measure, when the portfolio represents the entire investment funds, but when we use Treynor measure or Jensen's alpha, when the portfolio representing one sub-portfolio of many stocks. That's pretty much I want to say, because we only take one break here, so we can complete our discussion a little bit earlier. I'll be keep here for any questions so far. Okay, I'll be keep here to conduct my consultation service if you have, but I will be waiting outside. I'm outside. I'm outside.